Hello, hello. Good morning. Looks like we're live. Welcome, everyone. Thank you for joining. Running a little behind schedule this morning due to some technical difficulties. Looking forward to bringing you guys another really exciting way to save tax money on taxes in our series, Keep Your Profits. Today we'll be covering depreciation and amortization as a tax planning strategy. I hope you guys enjoyed last week's Augusta rule. My name is Ray Mejia, founder and CEO of FCF Consulting Partners. My goal with this webinar series is to pack as much tax planning, valuable tax planning advice to you, for you guys, within the last few weeks of the year, where you can work with your accountant, you can work with your CPA, your tax preparer, your bookkeeper, whoever it is you've got on your side of the fence to help you implement as many of these strategies as possible. That's my gift to all of you. And of course, if you guys feel that you need a little bit of extra a little bit of extra help, you're more than welcome to reach out to us, and we're happy to help you as well. So let's dive right in. Actually, let me just give it a couple of more minutes, let a couple of more folks come on in. Notice there were quite a few signups the last few minutes, so we want to let those folks get in here. Of course, you'll be able to catch this webinar recording shortly after. Just follow the post-webinar instructions. And if you guys haven't signed up or subscribed and followed us on YouTube, you'll also be able to catch these webinars as they come, as they're uploaded to YouTube. If you don't have time to catch them live, which makes complete sense, you guys are busy doing what you need to do to run your business, you can get a notification when I upload each of these webinars on your YouTube notifications, and you won't miss out on anything, at least not between now and the end of the year. So let's get started. Alrighty. Let's share the screen. Let's see if you guys can see my screen. Alrighty. Depreciation and amortization tax strategy. Our second installment of our series, Keep Your Profits. My name is Ray Mejia. I am founder and CEO and lead strategist at FCF Consulting Partners. I am happy to be with you guys today. Thank you for joining. Today, we're going to dive right into depreciation and amortization tax strategies. How can we leverage this as part of an arsenal of tax strategies to save tax money? Those of you who are joining are probably still kicking yourselves in the butt. Why in the world did I pay so much money in taxes last year? Maybe you've come to the point where you've realized that you need a little extra something. Just handing over your bank statements or your P&L and balance sheet to your taxpayer just doesn't quite cut it anymore. Well, this is what the value I am trying to provide in this webinar series is for, because we had spoken with quite a few folks the last few weeks of the last extended tax season. For those of you who file for extensions, usually file in October, and there were tons of you who were just asking us, how do I save more money? This just doesn't add up. There should be more. And that's the point of this. So let's go over the agenda. What is the power of the depreciation tax deduction? Who qualifies? What depreciation methods are available? How do we utilize depreciation? What other depreciation considerations do we have to take into account? How does amortization work? What is that about? What are the pitfalls to avoid in the event of an IRS audit, of course, what kind of supporting documentation should we have on hand? Should we be audited? And if you guys decide that you're maybe in over your head and you need some professional help, how do you work with us? So let's talk about the power of depreciation for a quick moment. What is depreciation? So depreciation is a tax strategy that allows business owners to deduct the cost of assets over time rather than all at once. Although you can deduct the cost of certain assets all at once, and sometimes that might be to your best interest and sometimes it might not. The cost is recovered through an income tax deduction. It may be taken by all entities that purchase property. The amount that may be deducted is determined by one of various methods provided by the Internal Revenue Service. There are special rules that allow taxpayers to take larger depreciation deductions in earlier years, such as bonus depreciation, Section 179, and some repairs. So we know a deduction is for tax purposes, fundamentally, right? You don't do anything with a depreciation deduction as far as cash. There's no money coming from this, right? This is all a matter of how do we quantify certain intangibles on our tax return to decrease our tax liability. Depreciation is one of them. The depreciation deduction can help businesses reduce their taxable income and lower their tax liability. If you're a C Corp, if you're an S Corp, you guys should be paying very, very, very close attention. It can also help businesses manage their cash flow by spreading out the cost of assets over time. Businesses that own assets that are used for business purposes are generally eligible to use depreciation. However, there are certain limitations and eligibility requirements that must be met. Of course, that's a disclosure, and we all know that to be the case. But I'm going to jump right into it because a lot of you guys asked me on my last webinar, Ray, could you show us some real world examples with a little bit more oomph, with a little bit more dose of what the deal is? Well, here's a real dose. This is an actual client. Of course, we're keeping things as generic as possible for the sake of confidentiality. Dr. Fernandez, real person, real doctor, real physician, real MD. He is in the business of facial aesthetics. So it's a facial aesthetics practice here in Florida. And they purchased a building. And in the purchase of that building, there was tons of value that we were able to identify for this client. And some of that value was the equipment that they purchased, the building itself. And what are we doing with all this value? Well, we're depreciating the living crap out of it is what we're doing. And so we found for this specific client, and full disclosure here, this is Tax Planning Live, just so that you know. This building was purchased in July of 23, and a series of necessary pieces of equipment were purchased as well for this practice to migrate from its location where it was renting out of to the new building. And this is real world going into the 2023 tax return for this client. $80,013 in depreciation deductions for this client. This translates to $29,605 in tax savings. Think about that for a second. That's $30,000 that Dr. Fernandez would have had to hand over in the form of a check to the Internal Revenue Service. Ray, this is BS. This is BS. Okay. To those who are saying this is BS, here's a screenshot of our depreciation and amortization tool that we use on the back end. And, those of you who love Excel spreadsheets like I do, you're more than welcome to use Excel for depreciating and following your depreciation schedule for your assets, or you can step into the 21st century, work with a virtual firm like ours who uses tools on the back end, many of which are being upgraded with AI, obviously, to give you guys the value that I'm presenting here in this webinar. $80,000 in deduction, resulting in $29,605 in actual savings. That's money that does not go in a check that would otherwise go in a check to the Internal Revenue Service, right? And this is it, screenshot. It's not just typed into a webinar deck. It's the actual screenshot from our tool. And so what is the power? What is the power of this, and who qualifies? Those are the biggest questions that people walk away with when it comes to these tax strategies. You know, what's the power? Here's the power: close to 30 grand in savings with one real world live example for 2023 tax planning. But who qualifies, Ray? Can I do this? Well, there are certain questions that we need to ask each other, right? Number one, is this asset that's being deducted for depreciation, that the depreciation deduction is being taken for, who's it owned by, right? Which one of your entities is it owned by? What type of asset is this? Is there going to be some determinable usable life to this asset? Is this asset income producing? Can this asset be expected to last more than 1 year? Of course, inventory does not qualify, right? So who does not qualify? Land doesn't qualify, but certain land improvements do qualify. Keyword, emphasis, underline, italicize, bold print, improvements. Asset disposed is the property that is being placed in service and disposed of in the same tax year. Is it intangible, such as a patent, such as something of intangible value to your business? Some of you are financial advisors. Some of you are very familiar with financial tools or financial instruments. Those of you that are, you know that those intangible assets may be amortized. Those of you, which the majority of you who are joining this webinar are more familiar with tangible assets, real world, you can touch, see, taste, and smell them. Those are the assets that we're primarily focusing on for depreciation. Those that you can't see, touch, taste, and smell, we're going to amortize them. Term interests, a term interest in property for which the remainder interest is held by a person related to you, does not qualify. We can, of course, dive much deeper into this, but we just want to give you guys some preliminary value off the top. So what are some of the depreciation methods without getting too fancy here, without getting too into the weeds? Well, there's straight line depreciation, which is what we're going to primarily focus on. There's declining balance depreciation. Straight line depreciation is a uniform style or method of depreciation where there's a systemic value that is depreciated every single year in linear form, hence straight line. Declining balance is relative to what this thing is worth according to your books. So there's a book value times a depreciation rate or table. Mostly this aligns with assets that depreciate fairly quickly. Units of production depreciation, some of the years, digits. If you guys want to get really dirty with this and roll up your sleeves, I'm happy to do so. MACRS, which is an accelerated method governed by the IRS very strictly. But we're going to focus on primarily here on straight line. We'll touch a little bit on MACRS. Bonus depreciation. This one's interesting. This one was with the signing of the Tax Cut and Jobs Act taking into effect in 2020, extended bonus depreciation and increased the allowance up to 100% of the purchase of a specific kind of property that you placed in service in that year. Layman's terms, you bought it, it cost you $100,000, you could depreciate $100,000 in that same year. Of course, that asset needs to have a useful life of more than 1 year, and that property must originate with use of the purchaser. Use property only in certain circumstances. Bonus depreciation is huge for a lot of you guys. Many of you may have taken advantage of it. But there is a sunset rule on bonus depreciation as we know it. The property classes for bonus depreciation, useful life up to 20 years or less, may qualify for 100% deduction. The bonus depreciation will be phased out. Here's the sunset, beginning in 2023 with no bonus amounts allowed in 2027 and beyond. Default depreciation method may opt out, but must opt out on all assets in the same asset class. I know things are getting a little fancy here, but bonus depreciation summary is huge, and some of you may still be able to take advantage of it. And now is the time to review your financials to determine if that piece of equipment if that vehicle, if that property, if that asset needs to be purchased now before the end of the year to take advantage of a bonus depreciation. Section 179. Section 179 is a permanent, unlike the bonus depreciation. Section 179 is a permanent tax provision for increased expensing of property purchases. There's a limit, like everything else, limited to $1 million in a taxable, adjusted for inflation, 1.16 million for 2023 in taxable value. It phases out at a dollar for dollar amount if total property purchases in the year exceed 2.89 million. So in layman's terms, if you guys buy anything in excess of 2.89 million, your dollar for dollar amount that you can depreciate is reduced according to a table. Section 179 is taken before calculating any bonus depreciation or regular depreciation. When to utilize special depreciation, guys. So after 2022, you want to take, the maximum amount of depreciation in the easiest, keyword, emphasis, italicized, bold print, underline, easiest way possible. You have certain assets that can qualify for Section 179 expensing. Your state does not have to accept the federal bonus depreciation. This is a separate conversation that we cannot get into with all of you. But some of you do have state considerations. We take state considerations into account with all of our tax planning. But for the purposes or for the effects of simplicity and to demonstrate the most value for your time and ours, we're only focusing on the federal implications of these tax planning strategies. But make no mistake, the implications can be significantly greater. Well, not significantly. They can be greater. They can be emphasized at the state level, depending on what state your business finds its jurisdiction in. You want to achieve a certain dollar amount of depreciation when you utilize special depreciation. So you're phased out of Section 179. That's when you want to utilize special depreciation. And when you expect your business use of said assets to drop below 50% in the future, you want to use special depreciation. Now, other things to take into account when it comes to depreciation and amortization strategy. This one's key, especially for those of you who have properties, qualified improvement property. Improvements that are made by a taxpayer to an interior portion of a business use building, non-residential use, retail store, factory, warehouse, you name it, that has already been placed in service. You guys make qualified improvements to that property, and we're talking about the QIP for you. Typically considered a 15-year property, which would qualify for bonus depreciation. The property is typically excluded from 168K under the Tax Cut and Jobs Act. Technical correction was made in the CARES Act of 2020. And the QIP does not include enlargements, additions, elevators, and escalators, or internal structural work. Now, let me just emphasize this. You can basically leverage qualified improvement deductions with the exception of enlargements, additions, elevators, escalators, or internal structural work. So a lot of the improvements and renovations that you do to your properties, no matter how long ago you bought that property, if it's being quantified correctly through the accounting, we can leverage that expense and capitalize that expense under the QIP. Listed property. So listed property is not what it seems. This has nothing to do with real estate property listings. Listed property includes cars and other property used for transportation, property used for entertainment, and certain computers. The amount of depreciation allowed annually for listed property may be limited by the maximum dollar amounts from another IRS table. The weight of a vehicle, for example, can change the amount of the maximum dollar deduction allowed. The percentage of business use, generally 50% or more, can impact whether you can take Section 179 or bonus depreciation on that vehicle. This one's a popular one. I've seen this one online a lot. If you guys find yourselves in need of purchasing a car, which my condolences to anyone who's trying to buy a vehicle right now, considering car prices and everything that's happening in the vehicle market. But if you're looking at buying a vehicle for business use, this is a very valuable deduction. You can, depending on the curb weight, as it's called, of that vehicle, you can buy that vehicle and you can take a full depreciation of that vehicle the year that you put it in use. So between now and December 31st, you can buy a vehicle that meets the gross or curb weight, requirements, and you can depreciate the full purchase of that vehicle in the tax year for 2023, as long as the bill of sale document is signed and the vehicle is put into service, as it's called, by no later than December 31st, 2023. State depreciation, again, rules state by state may differ. Each state may comply or follow federal law in different ways. Fully comply to match federal laws or not comply at all. They may partially comply and only adopt certain federal rules and not all of them. States may also comply differently during different years or partial years. Example, a state may not comply with federal 2021, but will fully comply with federal in 2022. The reason why I take a moment to talk about state depreciation is because if there isn't a tool or some sort of systemic manner to take into account what your state's rules are versus the federal rules, you can find yourselves with some notices at the state level. Inversely, you can find yourself with one of those fancy notices with those 3 letters on the top left corner coming from the IRS. We pride ourselves in using technology that allows us to check both of those boxes each and every time we're working on these tax plans for clients, state level and federal level. So continuing on how to utilize depreciation. So there's the purchase price or basis for the asset, the date the asset was placed into service. What's the percentage of business use of this asset? What is the life cycle according to the asset class? What kind of depreciation method are we going to use for this asset? And what's the depreciation convention for this asset? So I'm going to show you guys a quick table here just to freshen things up with some graphics. So let's look at years 23 through 28 from the left corner, from the top down. So for example, we're buying a $10,000 asset that we know is going to depreciate over 5 years because we've confirmed it with the table. If we were to take regular depreciation, straight line, we can depreciate $1,000 from this. And that's a $1,000 deduction on our 2023 tax return. If we do a double declining balance, DDB percentage, we can depreciate twice the amount, $2,000 in our 2023 tax return. But if we take Section 179 and do a full depreciation, because maybe this is, hint, hint, a vehicle that we purchased before December 31st with a curb weight in excess of 5,000 pounds, we can depreciate the whole thing and take a $10,000 depreciation. If we're not eligible for that, for maybe whatever reasons that may exist, we can take a bonus depreciation and we can take the DDB, the double declining balance percentage depreciation at 80%, while still taking a total of $8,400. So here's your choices. Choice A, straight line, take a $1,000 depreciation. Same asset, by the way, $10,000 asset depreciating over 5 years. We can depreciate $1,000. We can depreciate $2,000. We can depreciate $10,000, or we can depreciate $8,400. And depending on which one of these choices we make for this asset, 2024 is going to look like $2,000 for the first year. Excuse me, I should say for year 24. But for the first method of depreciation, $2,000. The second method of depreciation, $3,200. The third method of depreciation is $0, because we took full depreciation in the first year. The third, the last and final, the fourth method of depreciation, which is the combination of bonus and DDB, we take $6,400 in depreciation. And as you can see in front of you, the kind of depreciation schedule, or method that you would choose to take depends on the asset class, and all those other variables. But our job is to help you maximize. Your job for yourself is to help yourself maximize the depreciation based off of where you foresee your businesses moving in terms of profit and what your tax liability is going to be. If you think that you're going to be buying equipment regularly because your business is growing and scaling, or you have an exorbitantly profitable year in 23, you might want to consider a Section 179 depreciation basis for your basis, excuse me. On the other hand, if you feel like you are going to be growing steadily, you need these assets to grow your business. Maybe it's a laser printer that you're buying and not a vehicle. Maybe it's in the case of an aesthetics business, you're buying chairs and hydrofacial machines and all these other fancy pieces of equipment that depreciate over time. Maybe you want to take a double declining balance depreciation percentage. It's all relative to where your business is. And if you have questions on what is the method of depreciation that is most beneficial to you, I'm happy to jump on a strategy session with you. So what about amortization? I don't want to spend too much time on amortization because we can get easily into the weeds here, but amortization is the process of spreading the cost of an intangible, can't touch, see, taste, or smell it, asset over its useful life. The differentiating between amortization for intangibles and depreciation for tangibles. Common examples of intangibles are patents, trademarks, and goodwill. Here's the formula for amortization for those of you who fancy formulas, and no residual value in most cases, leading to a straightforward calculation. So, this is something that is very valuable, by the way, for those of you who are in the tech space, and your tools, your algorithms, your software, the development of your apps. This in combination with R&D tax credits would be a very valuable tax planning strategy for you all. We've got a couple of clients in the tech space, and we leverage these pretty heavily. So if you want to jump on a meeting and talk a little bit about it as it relates to your company, we are happy to do that. So what are some of the pitfalls to avoid here in general? And I think this applies to everything, really, not just depreciation. This applies to all of the strategies that we're going to be covering in this series. Pitfall 1, incorrect method, right? Incorrect anything. You want to make sure that you know what you're doing. And maybe you say, Ray, you know what? I just give my bank statements to my tax preparer and they take care of it. Are they really taking care of it? If you really want to maximize any of these strategies, there should be a conversation around what strategies are being used, why or why not. And once that conversation's had, you go through this checklist of 4 pitfalls to avoid. Am I using the right depreciation method? Is this useful life determination or estimate accurate? Am I keeping records correctly? And am I overlooking depreciation recapture? This one is pretty heavy hitting when we don't take this into account in advance. So I'll just let you guys know. If you buy something and you depreciate it before its life cycle and then you sell it or offload it, you're going to get some depreciation recapture. I'm going to say that again. If you buy something and you depreciate it fully or partially, and you sell it before the life cycle meets the price that you sold it for, you're going to have some clawback from the IRS. So you definitely want to keep an eye out for overlooking your depreciation recapture. You want to avoid that by any and all means necessary. Now, don't get me wrong. Some of you guys will need to sell these assets for whatever reasons. It's a lemon. Maybe that line of business just isn't profitable for you and you got to do away with it. Well, that's fine. You got to do what you need to do and you need to run your business. It's the way, it's the reality of things. And we understand that very well. But maybe you want to have a conversation about strategy before you do that, because there must be a way, one would assume there must be a way to offset that recapture with other strategies. And that's the only natural next course of thought that we at FCF Consulting Partners, we gravitate to. So a strategy conversation is important when you do believe that you're going to find yourself selling an asset that you haven't fully depreciated according to the schedule yet. And you got to do it. You got to sell it. So what is this depreciation recapture? If I haven't explained it well enough already, it's when the asset sold and the amount of depreciation or amortization previously taken can result in additional taxes. Often the taxpayer is not expecting the impact of depreciation recapture when they sell the asset. Depreciation will reduce the basis of the asset sold. The accelerated depreciation may be recaptured if an asset is sold for a gain, but will not reduce a loss. Depreciation recapture is treated as ordinary income. So we don't want to hurt one thing while we're trying to help another. So definitely worth having a conversation with your trusted advisor, if you will, when it comes to depreciation or leveraging that strategy heavily for 2023 or onward. Supporting documentation. Listen, y'all, I'm not going to get into documentation and examples in some substantial way, but the purpose behind this slide here is to let you guys know you need to have your ducks in a row. Everything you do needs to be in order. It needs to be documented, and those documents need to be in some sort of universal storage mechanism, whether it's online, a safe somewhere, or some sort of archive somewhere you've got in the back office. But you need to have your documents and all your ducks in a row, because you never know when you're going to get audited by the IRS. Now, if all of this sounds like it's just a little too much, but by the same token, you've never had this kind of a conversation with your CPA or tax preparer who's been doing their work for you and your mom and your dad and your grandparents for decades and eons, and all of a sudden Ray's talking to you about this stuff, then maybe it's time for you to have a conversation with someone. And if you want to work with our team, we're happy to do that. We're happy to help you. That's what we're here for. I like using this metaphor. If you joined us on last week's webinar on the Augusta rule, you'll find this little metaphor image familiar. We think of working with your CPA versus working with a strategic planning and advisory firm like this iceberg here. So what you think your CPA is saving you in taxes is the tip of the iceberg. And we'll save you that tip of the iceberg too, but we focus on more than that. We will save you with tax planning so much more than what meets the eye, so much more than what's on the surface. And that's the whole concept behind working with a firm like ours. Tax planning, tax strategy, and a lot of it flows into the accounting strategy. But Ray, accounting is accounting. Accounting is accounting. But sometimes the strategy that the business has, or the aspirations that the CEO has, or the goals and objectives that the CEO has for the business in 23, 24, 25, 5-year plan, whatever that is, that needs to be met in the accounting as well. And that's where we come in. Our approach to minimizing taxes is focusing on strategies that hit the nail on the head with quick wins. Retirement, deductions, such as we've covered today, legal entity structure optimization. You guys would be surprised the number of businesses that we talk to that have been in business for decades, or a decade or longer, and they're totally not optimized from a legal entity structure. And that's where we kind of start everything, is how are you legally formed, and does that make sense for your business? There's insurance. There's tons of loopholes. The Tax Cut and Jobs Act updates that have taken place since it was first signed into law in 2019 and put into effect for the 2020 tax year. There are niche specific strategies. I touched on them earlier with those of you in the tech space, those of you that must be leveraging strategies that are specifically tailored to your industry, those niche specific strategies, they cannot be avoided. They should not be ignored. Inflation Reduction Act recently signed into law, and there's some new tax policy coming on the horizon. And that's our approach. Our approach is taking all of these, and we'll assess them for you and put them into practice using our tool, using our tech, which I've showed you a screenshot of in this real live exercise for Dr. Fernandez for the 2023 tax year, how we've saved him close to $30,000, that's $29,605 by leveraging these strategies. And that's what we want to do for all of you. I think that this is a good time to answer any questions that you guys might have. I see some questions here. Let's see, Paula has a question. She says, can I buy something for my business, use it personally, and use it yes, you can. You know, what's a good example of that? I guess a vehicle is a good example of that. If you buy a vehicle and you use it to go from your home to your office, meet clients, run errands for the business. I mean, something as simple as, you know, FedEx, UPS, picking up product, dropping off product, maybe delivering product. I mean, that's a legitimate vehicle that's used for business purposes. Maybe it's not used 100% for the business, and that's a conversation that we can have one-on-one. But yes, you can buy. Oh, okay, and yes, you can buy the vehicle individually. You could have owned the vehicle individually. Yes, there are some things that we need to do to recognize the vehicle's use for the business. But you know, again, it's your business, it's your vehicle, and if blending the use of both of them is what allows you to make your ends meet or subsist, because you're fully self-employed, that's a very valuable conversation to have. What other strategies are available like this? Okay. Richard. So Richard, there are tons of strategies that are available for tax planning. Not all of them are going to have the kind of quick wins and major impact that you would expect, depending on your business. Some of the strategies that I believe are the most quick wins are your administrative home office, which, by the way, we're going to be talking about on the third installment of our Keep Your Profits. We'll be talking about how to leverage your administrative home office and take administrative home office deductions, expense deductions for your business, using a dedicated space in your home for your business. How do you do that? How do you keep records of it so that you can take the maximum amount of deductions for the space you use in your home for business purposes? Goes hand in hand with the Augusta rule, which gives you tax-free income. Hiring kids is a really valuable asset. This depreciation is extremely valuable, depending on how long you've been in business and what the volume of assets you have to run your business, or if you continually buy assets to grow and scale your business. Depreciation is extremely valuable, and there's tons more. Any of you who want to learn a little bit more, what's available, what is really most tailored to a business like yours, or best tailored for a business like yours, happy to meet with you guys. Book a meeting. No commitment, no cost. Calendly.com/virtual CFO Ray. That's calendly.com/virtual CFO Ray. And looks like we don't have that many questions today. You guys have been very pleasant and easy with the questions, so I appreciate that. I want to thank you all for joining this webinar. We'll be having our third webinar. Like I said, I'm trying to make these once a week through the end of the year to give you guys some quick, real, valuable information. so that you can either put it into practice before now and the end of the year, or start making moves for implementing them beginning January of 24. Either way, I want to thank you all for joining. ray.mahia@fcfconsultingpartners.com. You can email me anytime. You can call or text me at 786-475-7735. And of course, if you want to schedule a meeting, calendly.com/virtual CFO Ray. Thank you guys. I'll see you on the next one, hopefully next week. The third installment of our series, Keep Your Profits. Talk to you soon. Thanks again.